If you want to know how the dollar's doing, ask yourself the dollar price of gold. Well, right now, interest rates are going up, the dollar is getting stronger, and the dollar price of gold is going down. There's every reason to expect that will reverse sooner than later. This is not the first time we've seen interest rates spike. If you go back over the last 10 years, the yield to maturity in the 10-year Treasury note has spiked on a number of occasions, but notably, it hit about 3.5%, came down. Then there was another spike around 2.5%, came down again. A third spike around 2%, came down again, and right now it's spiked up to 1.6%. Notice the pattern. A technician would first of all point out that this is a pattern which is called lower highs and lower lows. In other words, there are highs and lows, there is volatility, but each high is a little bit lower than the one before, and the trend is down, and each low drops lower than the one before, which means you're getting closer to zero. So we have a spike right now, and the price of gold has gone down, but one of two things is going to happen. Either that's going to turn around. There is no inflation. The interest rates are going up based on inflation expectations. And I want to emphasize the word expectations. We have this $1.9 trillion spending bill. They're going to, in the US, they're going to hand out $1,400 checks to everyone pretty much. The expectation is people are going to run out and spend the money, and that's going to boost GDP and exceed available capacity, and we're going to get inflation, so interest rates are going up. No, none of that's going to happen. We are going to hand out the checks, but the evidence is very good that people don't spend the money. They actually save it. And I'll refer you to this chart, which is the savings rate. Now, if you notice, this goes back 20 years. The U.S. savings rate runs between 5 and 8%. It's very steady. Again, some wiggles, some volatility. Picked up a little bit in 2013, but it kind of runs pretty consistently between 5 and 8%. Look at what happened at the start of the pandemic. It went up to almost 20%. I think that's over close to 30%. So it spiked to 30%. It came back down, but it didn't come back down to the range. It came back down to around 13 or 14%. And in the most recent reading, it spiked up again closer to 15%. These are sky high interest rates. These are like Chinese interest rates in the United States, which means that you can hand out money, but people aren't spending it. They're putting it in the bank, or they're paying down debt, which economically is the same thing. They're deleveraging their balance sheet. So again, pushing money out the door doesn't do any good if people don't spend it. And right now they're not. People are, if you've lost your job, you're not taking your friends out to dinner. You're putting the money in the bank or paying off your credit card. Even if you haven't lost your job, you might be concerned that you will lose your job or your company will fail next month. And so you're putting it in the bank. It's what economists call precautionary savings, or saving for a rainy day. So here you see the savings rate going up. That's what stands in the way of government spending really stimulating the economy. And then coming back to what we showed earlier, the inflationary expectations are going to be disappointed because people are not using the money to spend and stretch the capacity of the economy. They're saving it. So when that data comes through, probably by mid-year, the interest rates are going to come back down. The price of gold is going to soar, and we're going to be back into that upward trend we described. Now, what if I'm wrong? I mean, I don't think I am wrong, or I wouldn't have explained it that way. But what if I'm wrong and the inflation actually shows up? Guess what? Gold's going to go up. In other words, gold will go up if interest rates come back down, or if we get actual inflation, gold is going to go up, because it always does in inflation. Right now, we have the kind of the worst of all possible worlds. We have higher interest rates in anticipation of inflation, but we have no actual inflation. So there's no actual inflation there to get the price of gold going, but the higher interest rates are a headwind because it makes the dollar stronger. So one of two things is going to happen. Either those rates are going to come right back down, which I expect, or the inflation is going to show up, which I don't expect, but I can't rule it out. But either one of those is going to get gold going back up again. And let me just flip ahead, Sean. Here's just a very simple illustration of where the price of gold is going. Now, this is in what I call a monetary reset. This is what would happen if you had a gold standard. I'm not saying we will have a gold standard. There's not a central bank in the world that wants a gold standard. But if you thought about it, if you wanted to have a gold standard, or you wanted to just use gold as a metric in terms of monetary policy, here's what you'd have to take into account. So let's just start with the money supply. M1 money supply, and I use the large economies: US, China, Japan, the Eurozone, and the UK. And you can include Australia, Canada, New Zealand. The numbers don't change that much. They don't change significantly. But that's about $32.3 trillion. How much gold is there? Well, there's official gold, about 34,000 metric tons. And people say, well, there's not enough gold to support the world money supply. Maybe there was once upon a time, but commerce and payments and leverage and debt and everything has expanded so much that we don't have enough gold. And the answer to that is nonsense. There's always enough gold. It's just a question of price. So let's just do the math. So with 32.3 trillion of money supply, what if you wanted a gold standard with 40% backing? Well, that means you need $12.9 trillion worth of gold. That's 40% of 32.3 trillion. So I said we have 34,000 metric tons. Let's just take $2,000 per ounce. I know gold's about 1,700, but just use $2,000 per ounce for a round number. Gold has been there recently. 34,000 tons times $2,000 per ounce is $2.2 trillion. Well, I said we needed $12.9 trillion. Well, it looks like we don't have enough gold. But what happens if we change the price, come down to the second row, to $12,000 per ounce? Well, voila, 34,000 metric tons at $12,000 per ounce, it's $13.2 trillion. That's more than enough to back global M1 at a rate of 40%. So the point is, there's always enough gold. It's just a question of price. But if you want a gold standard, or if you want to use gold as a metric, the price has got to be $12,000 per ounce. If it's not, if it's any less than that, you've created a deflationary system. You're repeating the blunder of Winston Churchill in 1925. So my point is, it's not that central banks are going to opt for a gold standard. It is the case that this is the direction gold is going, and it's going to get there sooner than later, because of so much money printing and ultimately a loss of confidence in the dollar itself. And just one last slide. Here is the history of bull markets. And I don't have any bull markets before 1971. Well, there's a reason for that, which is because before 1971, gold was money. It wasn't a question of, there was a gold standard, there was a fixed price for gold, but gold was actually a form of money. It was treated as such by the IMF and others. It was only in 1971 when Richard Nixon stopped the convertibility of dollars for official gold that the gold market went its own way. So we're now in the third great bull market. The first bull market you see goes from 1971 to 1980, and that was a 2,100% gain. Then we had a long bear market, just kind of flat to down, grinded down for almost 20 years. And then in 1999, the second bull market takes off. Gold was about $250 an ounce at the time. And that ran until August 2011, when gold hit $1,900 per ounce. And that gain was 670%. We're now in the third great bull market of history. It started, I can tell you the exact date, December 16th, 2015. Gold came in at $1,050 an ounce.